Hello, everybody. Welcome to 5 Ways to Save on Your Legal Malpractice Policy. Make sure it actually works. We're going to be waiting a couple minutes for some more people to stream in. Just see some people coming in right now. So thank you all for attending and thank you for your patience. We'll be beginning probably about 2:02 p.m. Hi, everybody. Again, thank you for coming. We're at 5 Ways to Save on Your Legal Malpractice Policy and make sure it actually works. We're here with trusted partner of Milestone, Klaus & Company's very own Dieter Klaus. We're going to wait until about 2:02 to get started. We have a few more people streaming in right now. So thank you for your patience. And finally, again, thank you everybody for 5 Ways to Save on Your Legal Malpractice Policy and make sure it actually works. My name's Sam Dolce. I'm an attorney here with Milestone Consulting. I have used and known Klaus & Company for a very long time. I believe Klaus & Company has been in doing legal malpractice insurance for more than 100 years. I tell from the black and white photos behind Dieter there. This company is experts in the space and has been experts in the space for a very, very long time. I think Dieter Klaus grew up in his crib reading legal malpractice policies and making sure that they were beneficial to the attorneys he works with. And so we're really, really happy to have them here today. At Milestone Consulting, we do qualified settlement fund administration, settlement planning for clients, and fee deferral for attorneys. With all that being said, while we are attorneys, we work with legal malpractice policies in our personal lives. We are not experts in it. So we look to trusted partners to sort of guide us in that. We work with lawyers across the country, and so we thought it would be of value to you to introduce you to a company in the space that has been doing this for a long time, very well. They're appointed with everyone they could be appointed with, and therefore they can always get the best deals, and really to kind of show us the details, the small prints, what we're not reading when we're running our law practice. As if you are running a law practice, you have associates under you, you're telling them what to do with your legal malpractice policy, but you may not even know what is in your policy. And so today I've asked for you to join us to run through a brief presentation, 20 minutes during the lunch break, to sort of show us the ropes, show us what we should be looking for, and a few ways to save. So with that, thank you, Dieter Klaus, for joining us so much. I'll be passing the reins over to you, and thanks for being a trusted partner of Milestone.
Of course. Thank you, Sam. We appreciate the introduction, and we've been looking forward to doing this for a while. Essentially, like you mentioned, my game plan here today is just to spend maybe 15, 20 minutes and go through a few ways that we might be able to help our law firms save on premium. And a lot of this is really just becoming an educated consumer. You know, we want our law firms to be asking the right questions when their renewals come up. We want them to understand what they're shopping for when they're shopping their insurance. So I'm going to run through some slides here. I know Sam's probably going to get to some questions at the end, and we'll jump right into it here. So this will all make a little bit more sense if you have a brief understanding of what exactly is going on in the malpractice industry, and specifically to law firms. So picture a graph and picture 2 lines, one for number of malpractice claims nationwide and one for damages, payable damages as a result of those legal malpractice claims. And what we're seeing is 2015 to 2018 roughly, those lines are kind of just cruising along stagnant. And in 2019, right before the pandemic, we started to see a pretty steep spike with both of those lines. And now we're really elevating with 3 straight years of increased claims and increased damages. And the claims are starting to level off, but the damages continue to increase. And so understanding that, you then obviously say, you know, what's the impact on my firm and what's the impact for insurance carriers? And so first, let's look at it from an insurance carrier standpoint. So I'm CNA or any large malpractice carrier. I see claims rising, I see damages rising. How do I combat that? Because I need to offset those losses. Well, I do 2 things. One, I become considerably more restrictive in firms that I'm willing to write. So my underwriting guidelines are much more restrictive. So firms with claims, firms with high risk practice areas, I'm less likely to offer coverage to those firms. And then the second thing I do, which is why probably most of you logged on today, is I go to get rate. And to get rate means that I increase premiums at renewal to offset the losses. And so how does that affect my law firm if I'm an attorney? Well, one, I'm seeing my premium increasing, but two, if I'm a partner at my firm, I'm probably having a conversation with my office manager. And I'm saying to my office manager, you know, aren't we having a conversation with Klaus & Company or with whoever we do business with about keeping our annual premiums down, and why are they increasing when we haven't had claims activity? So that's just a brief understanding of the industry. The first way that we're going to look to save is just simply by understanding the nuts and bolts of your policy. And so what we're going to do here is we're just going to review a standard declarations page, and I'm going to go over the specific points on that page that drive premium. You know, where is your cost coming from? And so we're going to look at the limits and the deductible and the type of deductibles and a couple endorsements on there that don't get paid attention to nearly enough. And you might take a look at your policy after this and just sort of compare apples to apples and see, you know, how yours looks into comparison with what we're going to discuss here. So here is a standard legal malpractice declarations page. And if you look at this, this is issued by Greenwich Insurance Company, who's one of our carriers. And the first highlighted line is the policy period. So all of our policies, 99.9% are written on annual terms. And the first important thing that we're going to look at here is the limits. So right here, we have a policy with $250,000, $500,000 limit. So $250,000, the first number means per claim. That's the most the policy will pay for any one claim. $500,000 is the aggregate. That's the most the policy will pay total in a policy period for claims. So lawyers are smart people for the most part. So when they're looking for savings, they say, okay, Dieter, I have 250,000, 500,000 limits. Can I just eat into that? Can I just drop my limits down to 100,000, 300,000? And a lot of times the answer to that is yes, because the limits are a significant premium driver. But what you have to do here is you have to take an inventory of your law firm's risk portfolio. And that really starts with understanding your practice areas and how risky they are. So what I mean by that is if I'm a criminal defense attorney and I do traffic tickets and I have a relatively light caseload and I've never had a malpractice claim, I've been practicing for 20 years, I'm probably okay with saving $700 or something like that. You know, that's not exact, but I'm probably okay with cutting my premium and reducing these limits because my exposure to loss is considerably less than if I'm a commercial transactional law firm, or if I'm a real estate law firm doing 200 closings a month. So my point there is, yes, look into reducing the limits, get the options, but understand your exposure to loss. And that's a conversation that you're going to want to have with your agent. The last thing, I'll add this really quickly with limits. Carriers, more and more malpractice carriers are entering into the market, and they're trying to make it as easy as possible for firms to get coverage. So a lot of times we'll see firms shop their insurance around. They'll lower their limits as low as possible, and they're not taking into account the requirements that their lender is placing upon them. So make sure that especially if you're a real estate law firm and you have an agreement with a lender, make sure you're not dropping your limits to save costs below their threshold. The next thing we're going to look at here is the deductible. Similar to auto insurance or homeowners insurance, higher the deductible, lower the premium. If you want to look at cost, this is not rocket science. You know, if you're willing to take on more risk, the carrier is going to reward you in terms of cost. What I really want you to pay attention to here in the deductible section is the per claim portion. So there's two types of deductibles on your policy. Most firms, you know, this gets skipped over pretty easily. There's a per claim deductible, which means that for every claim in that policy period, I pay $5,000 out of pocket. And then there's an aggregate deductible, which is more broad and more expensive. And some carriers will put the aggregate deductible on there just, you know, arbitrarily. And the aggregate deductible means that no matter how many claims there are in a policy period, after I've spent that $5,000 out of pocket, that deductible is null for the rest of the policy period. So look at your policy, take a look at your limits, understand your exposure to loss, and then look at your deductible and your deductible type. You know, if I'm a firm that's had no claims, I'm probably okay with that per claim deductible. If I have high risk practice areas and I've had a bunch of claims, the aggregate deductibles could be valuable. So it's a cost benefit analysis. We'll skip over the next two highlighted sections for now, the retroactive date and the predecessor firm, and we'll jump down to two very important endorsements that get overlooked all the time and are significant price drivers. So New York damages only first dollar defense. Obviously, we're speaking specific to New York here. This means the first dollar defense endorsement means that your deductible only applies to damages. In other words, the firm only pays that deductible if the policy pays out. When there's a claim, the carrier is required to provide a defense, regardless of whether the grounds for that claim are meritless. So if I have first dollar defense, that's a beneficial endorsement for the firm because I only pay out if there's damages. But that said, this endorsement often just gets built into policies and you're paying for this. The first dollar defense is as broad of a deductible endorsement as you can have. So you're paying for that. You want to look at that and again, do the same risk and cost benefit analysis with your agent. Similar thing with claims expenses. The second highlighted item down there, this applies to the limits and not the deductible. So there's three types of claim expenses endorsement. Inside the limits, most restrictive, least expensive, 50% offset in the middle, and claims expense outside the limits, most broad. Outside the limits means that the defense costs never eat into that 250, 500,000 limit there in this case. 50% offset means that 50% of the defense costs can eat into that limit. And claim expenses inside the limits means that any defense costs eats into that limit. So think about your practice areas and think about how restrictive you want your defense expenses to be. Again, if I have no claims, I'm probably okay with saving the money and having my defense expenses inside the limits. So the last thing here is the retroactive date, and we'll talk about this further, but the retroactive date is usually as far back as the insurance has bought, as far back as the firm has bought insurance. So in this case, the first policy was written on January 1st of 2013. What we don't want you to do here is you're looking for a new policy, you're unhappy with your renewal terms. We don't want you to find a new carrier and write a policy that loses your retroactive date. And we say that because lawyers' malpractice insurance is written on a claims-made basis, and continuity of coverage is so important. What claims-made means is that there has to be a policy in force at the time the claim was made, and that claim has to stem from an incident that was after that retroactive date. So if I get rid of my insurance history just to save cost, and then I have a claim that arises in, 2019, I'm going to have a big problem. So pay attention to your retroactive date when you're shopping. Make sure you're not losing your insurance history. So that's understanding a declarations page. Obviously, most important things here are limits, deductible, and your claims expenses endorsements. How much risk are you willing to take on in comparison to annual premium savings? Next slide. So 99% of the firms that we work with are taking appropriate measures to be risk averse. And how are they being risk averse? Well, they're using engagement letters. Again, almost all of our firms are using disengagement and engagement letters. If I'm a solo attorney, I usually have an agreement with a backup attorney who would handle my case files in my absence. I have docket controls and calendar systems for filing documents on time and staying in compliant with court regulations. And then the number one nationwide largest cause of malpractice suits is conflict of interest. So I should be reviewing new clients to the firm. I should be having them sign client conflict of interest waivers. And so to take this a step farther, because most firms are already doing these things, there's a conversation that has to be had when you're completing that renewal application at the end of the year and you're checking yes, I do engagement letters. Yes, I have docket controls. The follow-up to that is to go to your agent and say, is my carrier rewarding me for being a risk-averse law firm? And most of the carriers that we're working with are implementing programs to reward firms that are taking steps to avoid malpractice suits. I mean, again, think about this from the carrier's perspective. It's in my best interest to write firms and to insure firms that are risk-averse. So make sure you're asking your agent, Am I being rewarded for being a risk-averse law firm? And I'm going to dive into this on the next slide, but it's one of the most important premium savers that we see not taken advantage of enough. All lawyers have to complete CLE, continuing legal education. Many of our legal malpractice insurance carriers are offering specific discounts for individual attorneys completing CLE. And so this is great for the firm too, because most of the firms that we work with, if I'm a patent law firm or I'm a commercial law firm, I want my junior associates to take CLE because I want them to know what they're doing. And carriers are offering significant discounts for taking CLE. So if I'm an office administrator, I want to email my insurance agent and say, what specifically are the discounts for CLE for individual attorneys? And is it per attorney, or do all the attorneys in the firm have to take CLE in order to get credit? So that's something to think about. And these two slides kind of go hand in hand. So we want to take, when we're completing that renewal application, we want to take a really close inventory of what is being rated on the policy. What exactly am I paying for and who's covered? So one of the most common things that we see are, and this really happened a lot with COVID, there's an attorney in the firm who's worked for 35 years and it's time to scale back his practice. And he went from working 50 hours a week to working 15 hours a week. See, the problem is that for years, you've probably renewed the policy with this attorney as a full-time member. And the rate between full-time and part-time is considerably different. And it's not just full-time and part-time. A lot of the carriers that we work with are very specific. So if Jim Smith is working at your firm and he's only working 2 hours a week, that's the amount you want to put, because oftentimes the carriers will rate on specific hours. So then obviously you're looking at a difference between rating for an attorney who's practicing 2 hours a week in comparison to an attorney who's rating 40 or practicing 40. And the rate is very significantly different there. And this kind of goes hand in hand. So a lot of times firms will have of counsel agreements and they're required to carry those OCs on their current malpractice policies. But over time, of counsel relationships sometimes fizzle out. And so oftentimes we'll see an of counsel that's been on a renewal app for a long time, and we'll say to the firm, we do this with every firm, does this of counsel still render services on behalf of your firm? And this goes to the point of, you want to make sure that you're rating for the correct attorneys. I don't want of counsels on there that aren't performing work on behalf of my law firm. So the moral to the story here is, if you're a firm administrator or you're a partner completing your apps, focus really carefully on your attorney roster and then your practice areas. And when I say practice areas, I just mean understand what's high risk and understand what's low risk. Again, this is not rocket science. All attorneys, for the most part, get this. But litigation work, think of that as high risk in the eyes of the carrier. Criminal work, non-litigation, low risk. So make sure that when you're allocating your practice areas, you're thinking about, what are high risk practice areas, what are low risk practice areas. It's really important for potential price saving. So let's just go through the ways that we just discussed, to save and to be educated when you're shopping. So first and foremost, understand your firm and understand how much risk you're willing to take on based on your history and based on your practice areas. Second, look at your limits, look at your deductible, and look at your endorsements. Look at your claims expenses endorsements. That's what's driving your premium. So, understand if you have a broad claims expense endorsement where claims expenses are outside the limits, understand that you're paying for that. If you have first dollar defense, understand that you're paying for that. And what I always say is, if I'm a law firm and now I understand these things, I want to say to my agent, can you prepare 2 or 3 quotes for me with different options? And then I can have a meeting with my partners and we can decide what makes sense for the bottom line. And then the third thing, if you're a risk-averse law firm, like we talked about, have a conversation with your agent. Am I being rewarded for being risk-averse? Fourth thing, are my attorneys completing CLE? And is it in specific practice areas? And does my carrier have a rewards program for that? And then the last thing we just talked about is complete your renewal application accurately. Make sure the right attorneys are on there. Make sure the right amount of hours is allocated to each attorney. So we're just going to do three little, we'll call these FAQs, Sam and I discussed. These are things that we see every day in our work with law firms, and hopefully these can just add some value to you if you're dealing with one of these situations. So first off, we're talking about continuity of insurance here. And so law firms are no exception. Businesses are consolidating to remain competitive. And so ownership structures of firms change all the time. So let's just go through three scenarios of how your insurance is impacted if your ownership and makeup of your firm is changing. So scenario one, I'm, for the purposes of this exercise, Sam Dolce, and I'm retiring from the private practice of law. How does this impact my insurance? So we talked about claims made insurance. In order for a policy to pay out, we have to have coverage at the time the claim is made, and that claim has to be after the retroactive date or the prior acts date specified on that declarations page. So Sam wants to retire on 4/1 of 2022, and Sam wants to close his firm on 4/1 of 2022. Problem is that as of 4/1 of 2022, Sam has legal services that could be the basis of a claim. So Sam needs coverage for anything that comes up after 4/1 of 2022. And what he does is he purchases, if you look at the last bullet point here, he purchases a tail or an extended reporting period endorsement. And essentially that provides an extension of coverage for a given period of time for claims that may arise after Sam retires. And so you can buy a 1-year tail, a 2-year tail, a 3-year tail, a 5-year tail, and an unlimited tail. And we always recommend a 3-year tail because that keeps you in line with New York State statute of limitations, at least a 3-year tail, I should say. Scenario two, this time we'll do, Sam and I are partners at Klaus Dolce PLLC. And we've decided that our interests no longer align and we're going to split ways. But again, we need to address our insurance history. So this is pretty similar to scenario one. Sam and I obviously need to protect our past entity, Klaus Dolce PLLC. And so we do that by buying a tail, hopefully 3 years to keep in compliance with New York State statute of limitations for malpractice. And then Sam and I start, each of us individually, separately, start what's called a retroactive inception policy, which means that policy is going to cover our new firm for acts going forward. So that way we've insured future acts for each of us, and we've covered the acts rendered on behalf of the past firm. Scenario three is a price saver. So this one comes up all the time, and this one's important, and it gets missed quite a bit. So this time we'll do Klaus Dolce PLLC, but Sam and I have a third partner. And this time Sam and I like each other, and we're going to keep our firm intact. And Sam and I are the majority owners of that firm. Sam and I retain more than 50% of the assets and more than 50% of the liabilities. Newsflash for law firms, assets and liabilities are attorneys, clients, and furniture. So in this case, Sam and I are retaining the majority of the assets and our third partner is going his own way. So because Sam and I are the successor firm, we want to ask our carrier and our agent about predecessor firm coverage. That's the second to last bullet point here again, predecessor firm coverage. And for Sam and I, this is a great deal because it's considerably less money than purchasing a tail. It allows us to keep the prior policy in place because we're the successor, and it covers us for past acts and then future acts in the name of the new entity reflecting the new ownership. Our third partner is somewhat out of luck here, and he needs to start his own policy for acts going forward. But this is great for firms who have a split, and it's not an exact 50-50 split as far as assets and liabilities. One firm's retaining the majority of the assets. Two more quick things. Let's just talk claims for 1 second because this is really important, and we've seen it a couple times in the past year. So there was a case in Utah recently. A law firm was in the midst of a claim scenario. They'd gotten letters from a current client, and that client was alleging malpractice. And so the law firm responded to those letters. They offered to waive their fees. They explained why there was no wrongdoing and why they were in compliance with the regulations of compliance with the regulations of the court, back and forth and back and forth. And then eventually they realized, the firm that is, that they were in some trouble. And then they called their malpractice carrier. And so the malpractice carrier is required to provide a defense. And the malpractice carrier says, well, have you had contact with this client? And all of a sudden, the firm starts explaining how they've been managing their own claim. And that's a big no-no. It's grounds for denial, and we see it's the #1 grounds for denial of legal malpractice claims. So the third bullet point here is really important. Understand your duties and your rights under the policy. The carrier is required to provide a defense. The law firm is required to provide prompt notice of the claim. So if something comes up, immediately go to your carrier and to your agent. So the last thing here, I'm sure almost every firm's heard about this, but law firms are a prime target, unfortunately, for cyber criminals. That's because, one, law firms are usually running pretty successful businesses from a monetary standpoint. Two, law firms are really busy. And three, depending on the type of firm, if I'm a real estate law firm, I have tons of personally identifiable information in my system at a given time. And so we're seeing more and more that law firms are victims of hacks. And the most #1 common misconception is we'll have firms say, well, wait a minute, I have a malpractice policy. Isn't there cyber coverage built into that? And the answer to that is sometimes there's a small portion of cyber coverage, but nothing that's going to prevent you or protect you from, a funds transfer fraud or a social engineering claim. So most of the policies, or all of the policies that we're discussing with our law firms, cover first-party cyber liability, which is when a cyber event causes damages to your firm. If I need to recreate my network, recreate my files, there's coverage for that under the cyber policies we'd be discussing. And then there's also third-party cyber liability, which would be built in, and this would cover third parties, which are usually clients that were affected from a cyber incident. So cyber is important, and it's something to consider. We usually recommend that if you have a malpractice policy, which all firms do for the most part, it makes sense to have a cyber policy that runs concurrently. And if nothing else, have a cyber conversation with your agent when you come up for renewal. Take a look at what your risk is and see if it makes sense to pursue further. So Sam, that's all I got. I hope we've added a little bit of value here. We went through some price savers, obviously, and then hopefully those FAQs with ownership structures and how to handle your insurance will prove valuable. And have someone in your office administrator, look into your cyber risk and see if a policy makes sense going forward. Sam, I think you were going to take over from here, and I think you said we might have had a couple questions during that. I'm obviously happy to answer those. And again, thank you to you, and I know Jordan at Milestone was also involved with the slides. So thanks to everybody over there. I really enjoyed this, and hopefully we can do it again, and I'll answer any questions now. Thanks.
Peter, thank you so much for sharing that. I mean, I definitely learned something, and I've been going to you for years, so thank you. That was incredible. I am just going to wait for some questions to come in. Anyone who's in attendance, if you wish to ask questions, there is a questions tab on the right side of your screen. You'll see the control panel, big thing called questions. You can type your question in, and it'll show up, and I can ask it publicly. If you have private questions, Dieter is listed as contact information as well. I'm going to just kind of wait here for a second, and this is sort of a funny one. What are some ways people get ripped off? I feel like I'm getting ripped off. So
I can answer that.
Okay, what are some ways people get ripped off?
Yes, I like it. It's
pretty
direct. There was a slide. Let's see. Here we go. Almost all the firms that we work with are doing everything they can to minimize their risk. And almost all of them have attorneys that are doing continuing legal education. and they're not getting rewarded for it simply because they don't know the advantages. That's the first, that's number one. Number two, I would say, is they're not accurately representing their roster, and they're being overcharged for number of hours worked. You know, firms we see it all the time. Firms they're so busy and they're so quick to get that renewal that they're just kind of, you know, attesting that the information on last year's renewal application was complete, and they're filling it in, and they're not paying exact attention to number of hours. And number of hours that's how policies are rated. You know, they're rated on practice areas and revenues and number of hours. And so often there are partners that are active within the firm, but they're not working 40 hours a week. And so firms end up paying 30% too much just because of a simple mistake like that. As far as ripoffs or being charged too much on basic policy limits and things like that, that really doesn't happen. You just have to know your limits and your deductible. But that renewal application, being diligent in that renewal application can go a long way to minimizing costs. So I hope that answers the question.
Great. We have another question just came in. Does increasing my self-insured retention lower my premium enough to make it worthwhile? How high is prudent for the average small firm?
Yeah, it's a good question. So let's go back to deductible type here. So we talked about this. You know, the higher the deductible, the higher the risk you're willing to take on, the lower the premium. The standard, I'll give you the standard and the majority of the policies that we write within our firm. Most of our policies are written with $1 million primary limit, $2 million aggregate. That's $1 million, $2 million, or $1 million, $1 million. And most of those will recommend a $5,000 deductible or a $10,000 deductible. To be honest, that's not where the most significant cost savings are. I mean, unless you want to bump this 5,000 in this scenario up to a, you know, 15,000 deductible or 20,000 deductible, the savings aren't going to be tremendous. The more important part to consider when it comes to the deductible and the retention, this per claim part is really important. What is my deductible type? Do I have a broad deductible type like first dollar defense, or do I have a more restrictive per claim deductible? So my answer to that question would be, again, get your options. You know, look into, if I'm firm XYZ here, I'm looking into multiple limit options at renewal. And then I'm also looking into higher retention, and I'm doing a benefit analysis of what that premium is. So that's a long way to answer it. In short, just increasing the deductible is not the most massive price saver, generally speaking, but really pay attention to the deductible type because there are significant premiums associated with that.
Great, thank you.
Yep.
If you could just give a summary in 30 seconds, what's something that every lawyer should do now regarding their malpractice insurance? If they're going to review it, if they're going to change it, what is the elevator pitch, so to speak, of the one thing that's going to save all my friends in the trial bar money?
Yep, for sure. Number one thing you want to do. So first, let's do if I'm shopping. Okay, if I'm shopping for new insurance, I have to make sure that I'm keeping my continuity of coverage. That's number one, because losing this retroactive date, especially for mid-sized to large firm, it can be catastrophic. The second thing I would do is I would get a very good understanding of the nuts and bolts. I would understand my limits very clearly. I would make sure that when I get that renewal quote, it's an apples to apples comparison. And if it's not an apples to apples comparison, I need the new agent and the new carrier to specify where coverages are different. So now that's shopping. Let's talk if I'm coming up for renewal and I want to save 30 seconds. Look at my limits. what's my exposure to loss? What's my claims history? How does that factor into my limits? Can I drop my limits significantly to save premium without exposing myself to tremendous risk? And again, I keep harping on it, but if I'm looking to save and my practice hasn't changed a ton, let's get a little bit more exact about the renewal application. And for example, if you're working with most agencies, but if you're working with us, each year at renewal, let's just have a 15 to 20-minute call and make sure that everything on that application is accurate. Make sure you're available for all possible savings. The name of the game is keep costs down and keep risk relatively mitigated and low. So be exact at renewal. It'll go a long way, both for savings and for security of the firm.
Thank you so much, Dieter.
Looks like 30 seconds.
Yeah, no, that was great. It looks like we've gone a few minutes over. I'm sorry if we held anybody up in your day, but this was really valuable information. I really hope everyone is able to sit down with their deck page and make sure that no corners were cut, no stone unturned. And Dieter, can you throw up your information page one last time?
Absolutely. Yep.
And then if you ever need anyone to review your insurance, you have any questions regarding your insurance, recommend calling or reaching out to Dieter. Again, they've been doing this for more than 100 years. They know their way around a deck page. And sometimes I know as a trial attorney, life can get way too busy. So it's always great to have professionals you can rely on and trusted partners like Klaus & Company. So thank you, Dieter, and hopefully we'll see you soon.
Yep.
Thanks again.
Thank you.